Hello, my name is Sunil Bandari and I'm going to present this PQ Magazine Back to Basics lecture, and this is on weighted average cost of capital. Now this video is it accompanies or supplements an article that I wrote and was published in the May 2021 edition of PQ Magazine. I suggest that you get a copy of that particular article either from the PQ website, or alternatively if you send me a WhatsApp on the telephone number at the bottom of this particular video, I'll be more than happy to send you a PDF copy of that particular article. Now, this lecture is to deal with this area, weighted average cost of capital, and it is designed for students who are sitting the papers which I teach online, ACCA FM and ACCA AFM. Now what I want to do is to show you how you deal with what is going to be calculating the company weighted average cost of capital using the ACCA spreadsheet, not Excel. I'm not using Excel, I'm using the ACCA spreadsheet. And this lecture is by courtesy of my access to the ACCA practice platform, where you can see here what is the spreadsheet response area for calculations for both ACCA FM constructive response and all of the ACCA AFM questions. So what I want to present here is the calculations. The full explanation is within what is going to be the article, but I want to demonstrate those calculations to you, showing you how you enter them and how you present them using what is going to be the ACCA spreadsheet software. Now, in the article, which I've reproduced here to a certain extent, I used a past exam question from ACCA FM, which I'm going to adapt for AFM, and the question was called DINLA. I've adapted that question to accrue for what is going to be some of the ACCA AFM areas I also want to teach within this particular presentation. Now, the first thing I want to show you is that I have presented the key data here and just pulled it out of that question. You can see what I've got here. I've produced the ordinary shares, nominal value per share, what they're worth on the balance sheet, the market value. Preference shares the same, a 7% bank loan, which they also had, and then a 6% 5-year bond redeemed at par. The book value and the market value per block of 100. I've also pulled out the extra data I need, the equity beta, the dividend per share. They gave an annual growth rate, and then the credit risk premium. This comes into play in AFM, and just to either introduce or remind to AFM students, a credit risk premium is measured in basis points. A basis point is 0.01%. The risk-free rate, and then the equity risk premium or market risk premium, RM minus RF. Now, as I stated in the article, my approach to dealing with the area of weighted average cost of capital is to create what I call like muscle memory. You know, I enjoy running, so when I enjoy running and I enjoy running, say something like a 10k distance, I want to run to a certain speed. So therefore you practice at a certain speed to get that muscle memory. We often say that golfers who are practicing a particular golf shot have to go through hundreds and hundreds of golf shots to practice to get that sort of muscle memory. And I'm adopting the same approach here with weighted average cost of capital. I have an approach which says, first of all, work out the market values, the V's. Secondly, work out the cost of finance, the K's, and then put it together into what is going to be into the WACC using the simplest WACC formula. So it is work out the V's, work out the K's, put it into what is going to be the WACC. So let's start by working out the respective market values of, in this case, the 4 different forms of finance. Now I've set up a sort of pro forma just so it'll save us a bit of time, and I'm working in thousands on the market values, and I start with the value of equity, which is going to be set equal to, and what I want to know here is that in nominal value I've got 23,000 shares which are 0.25 each. So if I take the 23,000, divide it by 0.25, that converts it into number of shares in issue. If I then multiply that by the current price per share, 426, I get a value of 391,520. Let me now do the value of the preference shares. They're going to be set equal to, now I'll do a full calculation. It would be the nominal value of all of the preference shares divided in this case by 1, because they happen to be $1 shares. Be careful, they could have been 50-cent shares. I then look to multiply that by the market value per share. In it goes 2,800. Then we go for the bank loan. And the bank loan, there is no market value for a bank loan. It is the same as the book value. So literally I can just copy that value and take it across here and just paste it in there in terms of value. So straightforward 3,000 going in it goes in terms of the bank loan. And that leaves finally, last but not least, is the bond. Equal to. Now you've got to take the total book value of the bond, which is 11,000. Divide that by what is going to be 100 to put it in blocks of 100, and to multiply that by the market value per block of 100, enter, that gives you 10,500. So we've got number of shares times share price, number of shares times share price, book value equals market value, take all of the bonds, convert them into how many blocks of 100, multiply by what is going to be the value, the market value per block of 100. Now let's total those up. It's equal to SUM. I'm going to sum all of those up, enter, and I get a value of 408,220. 408,220. So that's the first bit out of the way. That's the V's done. Now we can go to the costs of finance. Now, to begin with the cost of finance, the K's, I want to do it in the order: cost of equity, preference shares, the bank loan, and then the bonds, which are a little bit more awkward to deal with. Now we start with the cost of equity, and there are 2 ways you could calculate this. You could use the dividend growth model, also known as the dividend valuation model, or you can use the CAPM model. And as I stated in the article, the dividend growth model has really been exclusive to FM. CAPM has appeared in both papers, but is the mode that's being used in what is going to be AFM. So let's start with the dividend growth model. Equal to, I'm going to put 3 brackets, bracket, bracket, bracket. So what do I want here? Well, what I'm looking for is the dividend per share today, which is what is going to be 0.25. I then want to multiply that by, and I want to open a bracket, 1 plus what is going to be the growth rate. So 1 plus what is going to be the growth rate as a decimal. Close that. So that will give me the dividend effectively for what is going to be next year. I want to divide that by what is today's share price. Today's share price is 426. I want to close that bracket so it works all that value out. I then want to add on what is going to be the growth rate of 0.04. I then want to close that final bracket. So I've closed that final bracket there. And then I want to multiply it by 100 to convert it into a percentage presentation. And I get 10.1%. And I think this is the one where it's a little bit more awkward to do using the spreadsheet rather than the old classic pen and paper. You just have to be careful that you're trying to take D01 plus G over P0 plus G and then put that into a percentage format. And if you're going to use the spreadsheet software as we're presenting here, you can see them making sure I get the brackets in what is going to be the correct place. Much easier for CAPM. For CAPM, we know it's going to equal the risk-free rate as a percentage. Yes, we have the risk-free rate. We add on to that what is going to be the beta factor, which we know has been given to us as 1.12, and we multiply that by RM minus RF, the equity risk premium, market risk premium. 8, enter, and that gives us 14.46. And that is automatically a percentage value there. And I'll repeat, the dividend growth model has exclusively appeared in FM. CAPM has appeared in both, but is the main mode of delivering KE as far as what is going to be the AFM paper is concerned. Let's go to the cost of a preference share. Now this is a very straightforward calculation. The cost of a preference share is the dividend valuation model. The dividend that is going to be repeating divided by what is going to be the current share price. So it's equal to open bracket. And I want to do the full calculation here. What is the fixed percentage on this preference share? It is 5%. So I want to put the decimal in 0.05. I'm doing this longer to make sure I cover all angles. That has to be multiplied by the nominal value of one share, which is 1. The nominal value of one share, which happens to be $1. That could have been 50 cents, and that's why I always go for the full presentation. I close that off. I'm actually going to put another bracket in actually. So let me go back in here. Let me put bracket, bracket. So I repeat that. Bracket, bracket, 0.05 into 1. That's the nominal value of a share into the fixed dividend. Then what I do is I divide that by what is going to be the current share price. I close that final bracket. And I want to present this as a percentage format, so I multiply by 100 because it's just easier that way around, and I get 8.93%. So you can see there it is the fixed percentage times the nominal value, dividend per share, over the market price. That gives you the value as a decimal, multiplied by 100, that gives you the value as a percentage. Another one out of the way. Now we go to the easiest form of debt that you're going to have, and that's a bank loan. And where the preference share only appears in FM. It's never appeared in AFM. The preference share has only been in FM, never been in what is going to be AFM. The bank loan can be in either FM or AFM. Can be either of them in terms of the exam. But the bank loan is the easiest one. All we're trying to do is to take the post-tax value of what is going to be the post-tax value of what is going to be the interest on the bank loan. Okay, so 7%. What's the tax rate here? I pulled it out. The tax rate here was 25%, was the value I gave in the question, 25%. So all I've got to do here is simply go in here, equals what is going to be the number 7, because it already is a percentage, and I've simply got to multiply that by 1 minus the corporation tax rate as a decimal, which is 0.25, enter, and that gives me 5.25%. So I've got two ways of getting the cost of equity, one way of getting what is going to be the cost of a preference share, and one way of dealing with a non-traded form of debt, the bank loan. Now, one of the massive changes that the ACCA spreadsheet software has brought to the advantage of FM and AFM students is the calculation of the cost of debt. And what I stated in the article is that the days of taking two estimates of a cost of debt, working two MPVs out, a high and a low, and using the interpolation method has gone. It has gone as far as what is going to be the area of constructive response questions in FM and any question in the area of what is going to be AFM. Also, the approach in the FM exam is different to the mode that we do in AFM. And I'm actually going to show you that when you do the method in AFM, it is easy. So we're saying that the concept of the IRR technique is still there, but the idea of trying to do a table and then interpolation has vanished. So let me show you what you do with the FM approach first of all. And with the FM approach, and I've done this, set this out for you, you must work out and present as a string of cash flows the post-tax flows starting with the market value as a negative. And in this question, the market value of the money, let's go back up here. It said that the bond was going to be redeemed in 5 years. It says a market value of 95.45 and it's got 6% what is going to be interest, redeemed at par. So the string of cash flows that applies there is at time 0 you've got a negative 95.45. You've then got what is going to be 6% times 1 minus the tax rate. That's the only post-tax element that comes in. So you've got 450 after tax for all of the next 5 years, but then in the 5th year you've also got 100 to add back for the redemption proceeds. And sometimes in questions they add a premium on redemption, add a bit more. Sometimes there's a discount on redemption, take a bit off. But once you've set those cash flows out, the cost of debt is straightforward. Equals IRR, internal rate of return, open bracket, highlight the string of cash flows, close the bracket, and just press enter. 5.57%. Done. Done. And as you'll see here, I've printed here, you've seen I've printed so the mark is very clear via the IRR function. And whether you're aware of this or not, ACCA FM constructive response markers and ACCA AFM markers can just click on your cell and see what you've done. Markers can mark what's in your cell. They know you've used the IRR function. That's great. So the first one is 5.57. I'm just going to type that in because I've got this column as a percentage. 5.57. Got it. Got that value in there. But when we do AFM, it is a different approach. AFM questions require a two-step approach. They say, number one, work out the yield to maturity, the lender's yield to maturity. Number two, multiply the yield to maturity by 1 minus tax. So number one, work out the lender's yield to maturity. And number two, multiply the yield to maturity by 1 minus tax, and you get the cost of debt. But there are two ways of working out the yield to maturity. And it's this next line here that's going to show that. what is the first way you can do it? And the first way is to take the risk-free rate and add on the credit risk premium. So in this case, that is going to equal. And that is going to equal, I go back up and I take what is going to be the risk-free rate. There is there 5.5. Now to that I want to add on, my credit risk premium. Now the credit risk premium is what is going to be 161, but it's 161 multiplied by 0.01, because it's 161 basis points, which in effect is 1.61%. In effect, it's 1.61%. We add that on, gets us to 7.11. So we're saying the yield to maturity is 7.11. What do I do next? I literally say what is the cost of debt equals the 7.11 multiplied by, I'm going to type this in, 7.11 multiplied by 1 minus the tax rate, which is 0.75. Done. 5.33. 5.33. And when I said to you that in AFM it seems to be way easier than FM, that's what I'm getting at. That the idea that you do a two-step calc, you work out YTM first using what is going to be risk-free rate, credit risk premium, and then you multiply by 1 minus tax and you have the value. However, what about if they don't give you a credit risk premium? If they don't give you the credit risk premium, how do you then work out what is going to be the YTM? The other way to work out the YTM is it's the internal rate of return of the pre-tax cash flows. The internal rate of return of the pre-tax cash flows. So you can see here where last time I used 450, I'm now using the full value of 6. So I've put the figures in, the pre-tax values, equals IRR, open bracket. Again, highlight the string of cash flows, and then close it and enter. And I've got 7.11%, which is the same answer right above, 7.11%. So a much different approach as far as what is going to be AFM is concerned. And I have to say, the method of YTM equals risk-free rate, credit risk premium, and then multiplied by 1 minus tax to get KD 1 minus T, that is the main method used in what is going to be the AFM paper. There's a little bit more to it, but hopefully I will teach you AFM, and I'll show you the other sort of variety of questions that come in relation to bonds. But this is all about working out the WACC and showing you the basic elements of it. 5.33, so I can put that in and we're ready to go. 5.33, so we're ready to go as far as that area is going to be concerned. So all we now got to do is calculate the WACC. Now finally, we can calculate the weighted average cost of capital. And to do that calculation, I need to basically take a value of equity times the cost of equity, plus a value of a preference share times the cost of a preference share, plus the value of debt times the cost of debt, all that totaled on the top, and that all of that total on the top has to be divided by the total value of the finance, E, BP, VD. Now to do that, I've actually calculated here 2 KEs and 2 KD 1 minus T's. So I've highlighted in red which one I'm going to use for my WACC for the purpose of this particular closing calculation. So I'll put in equals, or what is going to be bracket. So we start with what is going to be a double bracket, and we go to the value of equity, and we multiply that by the cost of equity. I'm using CAPM, which is the more accurate method. Close that off. Then I'm going to add, open that up, the value of the preference share. I'm going to multiply that by the cost of the preference share, 8.93. Close that off. Add to that, open bracket, the value of the bank loan, 3,000, multiplied by the cost of the bank loan, 5.25. Close that off. This is quite a long whack formula. Plus, open bracket, the value of the bond, multiplied by what is going to be the one I'm going to choose, which is the 5.33. Close the bracket, close the bracket. So that's totaled everything on the top. And then I'm going to divide that by, and I've got a total 408,220. Enter, and I've got a value of 14.12. 14.12. So you can see on the top, it's value times finance, value times finance, value times finance, all totaled up, all divided by the total value of what is going to be the finance. And we get a whack of 14.12%. At the end of the article, I've mentioned the potential use of the whack within project appraisal for both papers and business valuations when dealing with what is going to be free cash flows of a company within what is going to be AFM. Like I said, this particular video is accompanied by the article in the May 21 edition, May 2021 edition of PQ magazine. If you haven't got that article, please do get in touch with me with the number at the bottom, telephone number at the bottom, WhatsApp me, and I'll send you a PDF copy of that particular article. I very much hope you enjoyed this presentation. I wish you all the very best of luck in your future ACCA FM and AFM examination papers.